Let's talk about a big theme that we are watching here at Yahoo Finance, and that's the consumer. We've gotten earnings results out this morning from Target. That follows Walmart last week and a number of other big retailers, all warning that inflation is starting to hurt and has been hurting the consumer. This coming ahead of the Fed speak that we are getting later today. Officials widely expected to strike that cautious tone that we have been hearing all week. The fact that the data isn't giving us enough evidence to at least for the Fed to cut rates now. The FOMC meeting minutes are also set to be released this afternoon. So here to tell us what that means for the markets, the economy, where things stand today, we want to bring in David Rosenberg. He's Rosenberg Research founder and president. David, it's good to have you. So let's just take a step back. Just give us your sense of the consumer right now, the strength of the economy, and the consumer's ability here to withstand these higher rates for longer.
Well, I think that the economy was strong in the past tense. And of course, we had 3% real GDP growth last year. And so much of that was predicated on really three things: the credit card boom, the last leg of the excess savings drawdown, all that pandemic era savings from the stimulus checks got spent. And of course, we had tremendous fiscal stimulus. I mean, imagine last year to get the 3% growth, it coincided with a 35% expansion in the fiscal deficit. It just causes your eyes to roll. But that's your story for the economy. But as we saw in the first quarter, GDP growth 1.6%, probably going to get revised down. So the economy is weakening. The data aren't supporting that we're in a recession, just yet. And as for the consumer, it's not contracting. However, you're seeing a major shift in behavior, much more towards frugality. You're seeing that in terms of trading down. You're seeing that in terms of what the retailers are saying in terms of how the consumption patterns are shifting towards staples and essentials and away from big ticket discretionary items. And then when you start hearing stories of Ferraris and Lamborghinis being parked outside your local Walmart, things are even changing for the high income crowd.
Yeah, seeing a lot more Maybachs outside the Planet Fitness too. David, one of the huge things that I think we're continuing to try and get a sense of is not just the way that the consumer is defined, but also what they're doing in the near term to offset some of the stickier parts of inflation. And namely, it's going to be interesting to see in the Fed meeting minutes later on today how they're continuing to evaluate things like energy and things like home owners equivalent rent as well right now in the shelter and energy calculus of the inflationary picture too. What are you expecting there?
Yeah, well, very interesting comment because, the Atlanta Fed does us a great service. And after the CPI numbers come out, they create two series. One's called the flexible CPI, which moves with the economy and represents things that people can actually substitute away from. And then there's the sticky CPI. And that is basically things, as you had mentioned, not easy to substitute away from gasoline unless you'd rather walk than drive. And you mentioned insurance. Well, you're still going to insure your home and you're still going to have health insurance. That's been your primary source of the deviation of inflation so far this year. Rents are proven to be sticky because of the lag nature in terms of how the BLS constructs it in both the CPI and the PC deflator data. As Jay Powell had said, the rental part will disinflate more forcefully, but over time, there's just more inherent lags in that particular component. But, in terms of how are consumers responding? Well, as I said before, they are trading down. They're going more towards, private labels from brand labels. They are shifting their consumption patterns away from expensive items to cheaper items. They're really, you can see it in the data from spending on durable goods. That is really, there's no more really, all that demand has been satiated. You see that with Peloton as an example. So they're basically trading down. And that's manifests itself, I think, in something that we saw in last week's retail sales report, which is that the grocery chains are actually seeing more activity. And that's why Walmart's numbers were so strong, being such a massive food retailer. At the expense of what? Because we still have to eat. At the expense of restaurants. So all of a sudden, a lot of the stuff, the part of the YOLO spending, you only live once, and the reopening trade, all that spending on services, and especially on restaurants, because restaurants are, you don't have to eat at a restaurant, you could eat in your kitchen. And so that's something that you're starting to notice, before the consumer starts to contract. Everybody's saying, where's the recession? Where's the recession? The study of economics is ultimately the study of social behavior. And you're starting to see those early warning signs that people are fundamentally shifting their behavior, and this relative shift from restaurants to spending some time with the family in the kitchen and cooking at home. That's actually something that we should be keeping our eyes on.
Well, David, when you take a look, though, at the surge that we're seeing in commodities and gold and silver, even the run-up that we had seen in oil, does that suggest to you that this inflation issue, it's far from under control, or where do things then stand today?
Well, actually, everybody was saying, especially after the onset of the conflict in the Middle East, and then with Iran sending these missiles into Israel last month, that oil was supposed to be going over $100 a barrel. Where's that? Everybody, and after OPEC did their production cuts, extended them, we're supposed to have oil over $100. These are the experts on oil. So you just showed a chart before that we've fallen below $80 a barrel in WTI. Where's the inflation in that? Copper has its own idiosyncratic short squeeze situation, much like nickel did a couple of years ago. That's not really leading to a broadening out of the commodity base. So in answer to your question, I'm not saying this broad-based commodity-led inflation. You mentioned gold. Yes, gold, because the PBOC is ongoingly shifting its foreign exchange reserves from dollars into gold. India is the strongest economy in the world. Their retail demand for gold is going in a huge upward trajectory. This is just a shift in Asian consumption. One by a huge central bank, the other by consumers in the one area of the world that's growing 9%. There's no other really story there. There's no inflation story for gold. It's just what's happening in India and China. As far as the inflation is concerned, look, 100% of that deviation, everybody is just so anally retentive on the deviation in inflation in the opening months of this year. 100% of that deviation from the disinflation trend in 2023, 100% of it has come from insurance, health insurance, auto insurance, home and tenant insurance. They're not really moving with the economic cycle. I mentioned before about the Atlanta Fed. The Atlanta Fed, core sticky, which moves with the cycle and actually contains the goods and services that the Fed actually has an influence over. This year-over-year core flexible is running minus 0.3 year-over-year. It's deflating, and it's deflated now for 2 straight months. Nobody talks about it. Well, they talk about the fact that the core sticky is running at 4.5%. But by definition, sticky prices don't normally go down. Right. Sticky prices are not the things, unless the Fed wants to raise rates to 20 or 30%. How is the Fed going to have any influence over auto insurance, which has been this year's?
Yeah, when the meeting minutes drop later on today, we're going to see how they're talking about it, at least in those Federal Open Market Committee meetings. David Rosenberg, Rosenberg Research founder and president. Thanks for the time this morning.
Pleasure. Thanks for having me on.